Okay, let's get started. Hello, everyone. On behalf of the organizers, Michael, David, Yael, and myself, I want to welcome you to the lecture on entrepreneurial finance and innovation. And thank you for your active participation this year. And this is our last meeting of the year. And today we're very excited to have Professor Ayako Yasuda from University of California, Davis, presenting a lecture on creation or extraction, the role of private equity. Let me briefly introduce Professor Yasuda. Professor Yasuda is a professor of finance from UC Davis. Her research interest is vast, and most related to today's topic, she did a lot of impactful work on private equity, venture capital, entrepreneurship, and more recently on impact investing. Her research has been published in top-tier journals like the JF, the JFE, or the RFS. And equally important, she also wrote one of the first books on VC and PE for both academics and practitioners, titled Venture Capital and the Finance of Innovation, co-authored with Andrew Matrick. We are all very excited for a rumored new edition. Hopefully that will come out soon. And this is still a
February next year.
Next year, there we go. And I know Andrew was the reason for the delay.
Yes.
And this is still a must read for practitioners and academics interested in the topic. And it is our great pleasure to have Ayako talking about the very topic that is PE that she has studied for decades. So let me have a few housekeeping items. So the workshop will be 70 minutes long, more or less. But given it is recorded, we may go over time. And don't worry if you need to leave early. And you can use the chat function that everybody gets access to ask questions. And either Mike or I will interrupt Ayako when we see clarifying questions that may be useful to answer for everybody. And Ayako will kindly take 2 brief question breaks along the way. But in general, we encourage to ask only clarifying questions and quick questions. And everyone is encouraged to stay a little bit longer after the talk if you would like to discuss deeper questions with Ayako. With all that, now the stage is to Ayako, and we really look forward to what you have to say on the topic.
Thank you, Son. Let me share my screen. Can everybody see? Mike is okay.
Yes.
Okay. All right. So thank you for having me in this lecture series. It's really wonderful to connect this way virtually and globally to counter this isolation of the pandemic. I'm also very happy that vaccine was approved in the US at least. So hopefully we can be in an in-person conference sometime, maybe next year. Talk today is about the role of private equity in the economy. It's a pretty open-ended topic, and I really enjoyed thinking about it while putting together the talk and learning about the recent advance in the literature. I also benefited from discussion with Morten Sorensen, whom I'm writing a handbook chapter with on a related subject. So thanks, Morten. There's a lot of material, so I'll jump in, but just one point to make is that the list of papers in the slide isn't meant to be exhaustive. There are lots of great papers, and I didn't try to be exhaustive here given the time constraint. And I'm taking advantage of this being a lecture rather than a full survey. And I look forward to learning from the exchange and the feedback. So with that, let me start. So as you know, private equity activity level is at record level, near or at record level, about $750 billion trillions of deal activities per year in the last few years. And it's touching everything from the coffee you drink in the morning to the show you watch and the mortgage you pay. So it's more pervasive than ever. Yet as an industry, PE is still faceless in the public, and it's often depicted in the media as this sort of ominous organization, secret organization that ruthlessly profits at everybody else's expenses. That is very different from how private equity was first theorized in the finance literature. So initially, the motivation for private equity as a new form of organization came out of a critique of public corporations. Particular, Jensen originally said that the executives of public corporations have this agency cost problem. There is too much free cash flow, and executives start to do empire building by investing in negative NPV projects, and this is value destroying for the public shareholders. There are others who came up with different stories of the agency problem. For example, Bertrand and Leinathan, saying that, well, actually, when you have too much free cash flow, what happens is that the managers just enjoy the quiet life. The wages is high, plants are not really built or not be upgraded, so the productivity and the profitability also falls. And others also say that public company executives are engaged in short-term manipulations of earnings because of the way that they're compensated. It's too much focused on short-term results that are just very crude measures like stock price and earnings, but not enough monitoring. And that happens because there's free riding problems with the dispersed public shareholders. There's just too little monitoring. So all of that, it was posited that private equity would solve this agency and governance problems. So Jensen's idea was we need to lever the firm, and that because of the leverage, the future cash flow, instead of being wasted by the managers with the negative NPV projects, would be pledged to pay down the debt. And that's a good disciplinary device. And that's value creating for shareholders. Others say that give executives more equity incentives, which private equity does do, and that would align their incentives more with the long-term capital gain rather than the short-term earnings results. And yet others say that because of the increased monitoring, this unnecessary perks will be trimmed down, and that also create value for the shareholders. And because PE owns the firm outright, this concentrated ownership means there is improved monitoring incentives by the PE sponsors compared to public shareholders who have the free riding problem. So all of that suggests that there would be value creation for shareholders when PE owns the firm instead of the public shareholders. Now, we also want to think about the impact of PE ownership on other stakeholders. So let's take employees as an example. And now we have this strong principal who's closely monitoring and executives who are very incentivized in high gear. What would happen to the, for example, workers at the firm? Jensen suggested, the Schleifer and Summers, which also came out at about the same time as Jensen, suggested that this tends to lead to expropriations of the workers' benefits because, for example, that the executives with the incentives in high gear might decide to automate or offshore jobs, divest non-performing divisions. These are all value-creating activities for the shareholders, but that might lead to job loss, wage reduction, or benefit reduction. And that was the original argument that there is more of a transfer or extraction of values from other stakeholders to PE. On the other hand, the same type of incentive schemes put on the executives might lead them to invest in high growth divisions, which they are found to do, invest more in IT diffusion, invest more in high skilled labor at the firms they take over. And that might result in actually job gains or upskilling in the jobs that they had, or in productivity increase, and some of that rent is then shared with the workers. So which type of outcomes prevail is not very ex ante clear. And overall, there is ambiguous value implications for stakeholders when we think about what is the results of the PE ownership on the firm. I want to start with this because there is this sort of dichotomy between the Jensen argument, which is that the PE investors increase overall welfare, while the Schleifer and Summers argue that PE investors expropriate value from other stakeholders. And so it's usually framed normatively as creation or destruction. But I would argue that this dichotomy sows confusion and is not very helpful in promoting better understanding of the role of private equity for the society. PE is not really, it's more of a mechanism. It's not really a sentient normative creature. It's sort of like AI is neither inherently benevolent or nor malevolent. And so PE can be expected to create total economic surpluses and distribute them such that sometimes stakeholders gain while other times they lose. So the question should be when and how and to whom private equity is adding value, not whether it's creating or destroying per se. And there are lots of great papers that provides rich details of how and when and what are the drivers of those results. So now I want to talk a little bit about private equity as funds, because I think it has great implications for the value impact on stakeholders. And so a little bit about the economics of the private equity funds here. So PE fund is organized as a limited partnership, and it is typically a 10-year agreement between the investors, which we're going to call LPs, and the PE firms, which will be called GPs. The PE firms itself is an evergreen entity, and it could be private, or some of the large ones are publicly traded. Partnership itself is a private partnership that lasts for 10 plus maybe 2-year extension, and investors are making a 10-year commitment to the fund. Once they are in, it's hard to get out, and it's a closed-end fund, so you can't get in and out easily. So the only time they get to vote is to re-up for next fund if they are satisfied with the current fund. Scope of our talk today is mostly on buyout funds. So PE mostly means levered buyout. There are some studies that have some growth funds in the sample and some studies that only look at VC funds. So there will be some variation there. And leveraged buyout, I think you all know, but the one thing that I want to emphasize perhaps here is that there is both public to private leveraged buyout and private to private takeovers. In terms of the number of deals, most buyout activities is private to private. In terms of the deal value, public to private are larger. So they are about 30% of deal value, but still 70% of deal value is private to private. And that turns out to be important in thinking about what is the sample selection of our knowledge. It's really coming from public to private, and I'll come back to that. So other highlighting, other thing to highlight is that the PE funds control the firm, and the financing is done with use of debt. And they exit by sale, IPO, or secondary buyout. So when the fund is started, GP selects portfolio companies, and so you have a portfolio under the fund, and this is financed using the equity capital contribution from multiple LPs. The GP arranges debt financing so that it's a leveraged buyout, and leverage is taken at each portfolio company level, not at the fund level. And GP monitors performance of each company and receive fees from the LPs for doing that. After several years of holding those investments, portfolio companies exit. Some of those outcomes could be IPO exit or acquisition. Some of them could be going bankrupt and reorganized. Each individual outcome is realized, and then the exit proceeds go back to the fund, and GP distributes these proceeds back to the LP. And receive carried interest if the investments are successful. Now, if the once the fund one is going backwards. Once the fund one is completed, well, actually the fundraising happens while the fund one is still ongoing. The GP raises next fund, and if they're successful, the LP in the first fund mostly likely re-up. So maybe these LP2 and LP3 is re-upping, maybe LP1 does not, but the new investors also come in, they make commitments, and then the fund 2 is raised, and the GP will start all over again. So this fund economics drives a lot of what the GP is incentivized to do. There's a really big literature on LP performance, the financial returns that the LP receive. This is not part of the scope of the talk today, but I do talk about limited partners because the LP's objectives do matter, because it affects GP's fundraising. If the GP's objective is to maximize their own profits, that is to maximize fees and carry, they need to do that for the current fund, as well as present value of the fees and carry from the future funds that they'll be able to raise if they're successful in the current fund. And if you're very successful, you get to raise a large next fund, and that improves the present value of their revenue. So if the LP's objectives for investing in private equity change, GPs would rationally respond to cater to the changed objectives for its own survival as an ongoing entity and longevity. So who are the LPs? The biggest type of LPs for private equity is pensions, both public and private pensions. And more recently, the importance of sovereign wealth funds has also increased. So public money altogether comprise about 45% of the PE source of funds, 35% public pensions, and 10% sovereign wealth funds. Another 9% come from foundations and high net worth individuals. And all these four classes of investors' contribution to LP are increasing. So it's probably very important for GP to raise funds from these types of classes of investors. There's also a large increase in the amount of assets under management that are managed by signatories of the UN Principles of Responsible Investment. And as of 2019, $86 trillion are managed by, these are mostly institutional investors who pledge to the principle of responsible investment. So what is the UN Principle of Responsible Investment? There are two parts to what they say. The sort of the preamble to this says. One is that as institutional investors, we have fiduciary duty. And as fiduciary, we observe that environmental, social, and governance issues can have a material impact on the performance of the portfolios that we manage. So the first part is talking about materiality. We also, and then the second part says, we also recognize that applying these principles better align investors with the objectives of the society. And so wherever the fiduciary responsibility permit us to do, we're going to incorporate ESG into investment process. So there's been this huge increase in the percentage of investors and their assets that are pledged to PRI. And this has recently culminated in the head of BlackRock, Larry Fink's letter to CEOs in 2018, where he said, a company can achieve long-term profits without considering the needs of stakeholders. And this is a big deal and pretty much shook the whole investment community. We are starting to see evidence of that in academic literature too, where, for example, Kruger, Sartner, Stark's paper, JFE paper says that institutional investors already believe that climate risks have begun to materialize in their portfolio firms. Meantime, we continue to see that normative dichotomy that I alluded to before applied to PE, and most of that time it's sort of PE is portrayed as a villain, and in this one's as a vampires. So it's interesting to me that, you know, for example, Senator Warren is a policy wonk, and she has pretty good grasp of the intricacies of regulations that most politicians do. I supported her in the primary. So it is interesting to see politicians like Warren sort of anthropomorphize PE in this way. And in the backdrop is the increase in inequality and the anecdotal association that PE is exacerbating the inequality. So I think it's important that research informs the public what PE actually has historically done to stakeholders, the heterogeneity of the outcomes, and the drivers of that heterogeneity of the outcomes. So the literature that exists today has a lot to say about that, which I'm going to review in the second part of the talk. I think it's also equally important, in my view, to understand PE's response to this pretty big shift in LP's preferences. So, and there, I think the literature is pretty new and wide open, and there's a lot more work to be done. So I'm going to have there's some existing papers, and there are a lot of questions that are yet to be answered. So overall, it seems that in place of a normative discussion, a positive framework for PE is useful. And that positive framework for PE suggests that the PE as a mechanism is quite adaptable. I highly recommend this paper by Pedersen, Fitzgibbons, Pomorsky, forthcoming, I believe, in the JFE. It's a theory of responsible investing. And this is exactly the paper that I wish existed when I started studying impact funds. And I had this notion of an efficiency frontier to guide our empirical design and thinking, but there was no formal theory at the time. And now I can refer to a paper like this, and there are a couple of others that are contemporaneous with this paper. So it's wonderful. It's very, this taxonomy that they use is quite useful in understanding this. There are 3 investor types to derive the ESG efficiency frontier in their paper. The 3 types are ESG unaware investors. So they maximize LP wealth only. So that corresponds to the traditional PE. The second investor type is ESG aware investors. And they are aware that the ESG could have material impact on the portfolio while still having mean variance preference. And then there is the pro-ESG investors that has ESG in their utility functions. So if they are the LPs, then the GP as the agent could rationally maximize shareholder welfare for such LPs. So, and in terms of the practitioner, the lingo that they use, there are 2 types of sustainable investment that map to those second and the third investment type in the Pedersen et al. Paper. First is the materiality focused ESG investments. This is a strategy that incorporates ESG factors that could have an impact on the company's financial returns. So the focus, when we hear sustainability, there are two meaning. One is the sustainability of the company, and that's what the first one is about. So it's a single objective strategy, but with the awareness of ESG. In contrast, impact investing is the intentional creation of externality. So here the focus is sustainability of the broader society and the environment. It's a dual objective fund. And so that maps nicely into the pro-ESG investors in the paper. So there is this whole continuum, and the PE can be anywhere from this ESG unaware to pro-ESG. and we have some evidence of that heterogeneity in the data. So, so this is just, I wanted to set this up so that the rest of the talk makes more sense. The rest of the talk would discuss the literature on the value impact of private equity. And I organized it in this continuum so that we start with the impact recipient that's associated with the more traditional short-term shareholder wealth maximization. So it's an impact on GPs, and then gradually grow to broader and broader impact that corresponds to more materiality-based shareholder wealth maximization, and finally the pro-social shareholder welfare maximization, and that's the impact investing. So let me stop. One more slide and I'll stop. But, most of the literature here that we'll see now is empirical, and there are two empirical challenges in private equity research. One is the data availability. And because of that, there is sample selection, and we tend to write lots of papers that use public to private deals, or IPO exit firms, or firms with public debt, because they all have some public disclosures that we can collect. And we learn a lot from these data, but then we end up not really learning a lot about private to private deal, and that's a bigger portion of the universe of PE. The other empirical challenge is that the PE doesn't randomly buy companies. So there is selection by PE firms, and that has implications on the outcome that's separate from the treatment effect of what the PE does to the firm post-buyout. And disentangling these two effects are quite challenging. So with that said, there are papers that include private to private deals using sources like census data, IRS, or some regulatory data. And those really tell us a lot more about the heterogeneity. So that's a big plus when you can include private to private deals. There is also the comprehensive universe of everybody, mostly coming from European administrative data, and that's also a great way to learn. And then there is papers that take advantage of proprietary source that has some unique inside the black box view of private equity. So what the boards are actually collecting information on and things like that. So let me stop here, and please let me know if you have questions so far.
So I don't see anything in the chat yet. You're being very clear, so everyone seems to be following along well. But if anyone does have a question, again, just use the chat. We'll interrupt if it's worthy
Please,
of it.
Please feel free to unmute and just ask at this point. Just wanted to set this up so that we can start to talk about papers.
Okay.
Okay.
Good.
So clear?
I think so.
All right. All right. And I don't know if maybe I'm sorry that I was afraid of running overtime, and so far we are on time. So feel free to please interrupt and just unmute, and I want this to be interactive. So please do that, and or post put questions in the chat as well. Okay, so let me move on with the is the slideshow going? Okay, it was frozen for a second. Okay, so I'll start. So starting with the value channels for GPs, there are 5 categories of value creation. The first 3 are the 3 engineering that's identified in, for example, Kaplan and Stromberg. So governance engineering, financial engineering, and operational engineering. And then there are 2 additional that's less emphasized when we talk about the theory, but empirically there seems to be evidence that those are also important source of value creation for PE. So the governance engineering really goes back to the original Jensen argument of why private equity is better than public companies. So again, starting with the governance issue with public companies, executives may capture the inside directors, and they'll have entrenched management, and they will consume private benefits. And to counter that, public companies try to have independent directors, but then independent directors don't really have information asymmetry issues. So they over rely on hard information like earnings and stock prices, and they benchmark to peers. And then that leads management to manage earnings and lead to short-termism. So that's a problem with the public company. And private equity is offered as an alternative governance mechanism, and there is plenty of empirical evidence to show that they do things differently and in line with the theory of how this can be done better. So, for example, Ayako and Lerner find that new CEOs are often brought in very early days, within the 100 days. So replacement of CEO at the initial takeover is very common. Kaplan, Klebanov, Sorensen find that the certain characteristics of those CEOs that the PE bring in are associated with high performance. So for example, resoluteness and execution skill tend to happen to be more important than things like team orientation. Cronquist and Fallenbach finds that the equity grants that the management receive are higher, which others have also documented. And also that this equity grants performance vests, so they can't just get it, and they performance vests on pre-specified measures. And the measures they use are EBITDA or IRR or multiples as opposed to earnings, because earnings can be more easily manipulated, but they do not allow them to be evaluated on that measure. Katz also find, in line with the Cronquist and Fallenbach's paper, find that there's less earnings management for PE-owned firms. And Edgerton, interesting paper that looks at the size of the corporate jet fleets, find that after the public companies are taken over by private equity, the fleet size shrinks, which suggests that for public company executives, they are enjoying these perks that are not really necessary. Connelly and Komnek, Lundqvist and Connelly Karkas find that the boards work quite differently at PE-owned firms. The board size is smaller, independent directors number is lower, but they collect a lot more soft information, not just on hard information, and continuously monitor the executives. And this information of soft information and then the better monitoring leads to actually, once the CEO is chosen by the private equity, the turnover is lower, not higher. So, so those are, and then there are a lot more that document these systematic differences in the board. There's a caveat though, which is that the papers that study deals after 1980s find that the operating performance of these public to private deals actually doesn't significantly improve. And that suggests that but they still financially perform, which suggests that these are not the main drivers of the value that accrues to the shareholders for public to private deals. The second source of value creation is financial engineering, and original proposition by Jensen is that the higher leverage. And Kaplan, studying the early 1980s deals, do find significant tax benefits from increased leverage. Leverage was higher in the 80s, however, and now it's not as high. So the tax benefits seems greater then, just from the difference in the level. On the other hand, in 80s, the initial very high leverage at the time of the deal making came down quickly after the deal. In contrast, Korn, Mills, and Towery find that in the deals made in the 90s and the 2000s, the leverage kind of stays permanently elevated And that suggests that the benefits are still not insignificant, even though the level might be lower than before. There is this permanent high leverage choice. It's interesting that the tax, so basically this is the tax benefits. And the tax benefits for PE isn't restricted to just the choice of leverage. For example, Badisher, Katz, and Regal find that there is a higher propensity for tax avoidance from use of things like tax sheltering for PE-owned firms than for other private firms. So here the control firms are the private firms. And their argument is that because high concentrated ownership means the owners are more risk averse, so that individually owned private firms does less tax avoidance than PE owned firms, and that's what they find. They also find that larger PE firm owned, the portfolio companies of larger PE firms does tax avoidance more, and they interpret that to mean that there is a lower marginal cost of tax avoidance. Kilty and Sarin is a recent paper that studies PE-owned insurance companies, and they find that PE-owned insurers reinsure premiums with affiliates that are domiciled in tax haven. So this is the so-called shadow insurance, and they find that they're very active users of this shadow insurance in the insurance industry. And so for these types of tax reduction, that doesn't mean that the tax, the income interest go to the banks, and then banks may pay some income tax on that interest income. For the two papers here, the revenues are effectively reduced by the governments because it will never be paid by others. The third source of value creation for GP is the operational skill. So Bloom, Sutton, and Van Reenen has a series of papers that score management practice as sort of a technology. So they have categories and they methodically rank and score companies and their PE-owned firms and other types of firms in their vast sample that are cross-country. It's amazing data. And they find that the PE-owned firms are better managed than most other types of funds. So they're better managed than family-run, founder-owned, or government-owned firms. The only type of firms that are as well managed as PE-owned firms are public firms and family-owned firms that are managed by non-family member, like appointed outsiders. And in their paper, they have they look at what are the type of practice gaps for PE-owned firms. What do they do that are different from other types of firms? And they identify 3 sources of operational expertise. One is in the operation, and this is associated with continuous monitoring, constant collection of data, and then using the feedback to improve the operation. So it's usually characterized as this lean manufacturing practice that is very common at the PE-owned firms. The targets is about setting stretching, but realistic targeting, and keep doing that to improve the operational performance. And PE-owned firms are engaged in this. Surprisingly, the incentives of the management are not found to be significantly different. In terms of the centralizations versus decentralization, PE firms delegate to plant managers more than others, particularly in the area of sales, marketing, and new product launch. So echoing this finding, Bernstein and Sheen, studying fast food chains, find that restaurants are cleaner and better run under PE ownership. And Acharia, Gottschalk, Han Kiho, and Gompers, Kaplan, and Muhalyamov find that there is this neat sorting of the types of skill that the GP partners have and the type of plans that they implement after the takeover. So ex-banker partners do deals that then do a lot of M&As, whereas ex-industry managers or consultant type of partners do deals that result in an operational improvement. So these empirical studies show pretty compellingly that managerial expertise as value creation source for PE. And it makes sense that these type of operational skill is more lacking in private companies that can't really recruit talent. And after the PE takeover, that's where they are filling the gap. So theory is lacking in exploring this channel. The theory really emphasizes the agency problem. And agency problem perhaps is present there in public companies, and PE solves that. But these empirical studies show that not everything is about agency problem. So the fourth source of value is a removal of financing constraints. This is another idea that the theory doesn't pay as much attention, but there is pretty compelling empirical evidence that this is part of what PE does. So Kohn, Hotchkiss, Towery identifies there are two types of pretty different PE targets. One is poor performing firms, and the second is firms with growth potential, but are financing constrained. And for this latter group, they find that the growth increases significantly after the buyout. Similarly, Buckley, Threer, Tetzmar find that this is a French data study. PE relaxes credit constraint, and the growth goes up for private to private LBOs, and but not for public to private LBOs. And also growth significantly goes up for targets in external finance dependent industry. So again, suggesting that there is this pent up demand for financing that the PE then demands, PE then relaxes and then unleash growth. Fracassi, Privitero, and Sheen studies consumer products deals and finds that the sales increase by as much as 50%. Gompers, Kaplan, Haliamov, surveying what GP says they do, find that the private equity emphasize increasing revenue as a more important source of value creation than reducing costs. Biersinger, Birkin, and Lundqvist, using mostly East European data, finds that number one strategy that the PE uses is buying or upgrading assets, again, consistent with growth. Although one caveat in this study is that their sample overweighs growth investments as opposed to buyout investments. So it's not surprising that they pursue growth strategy. But that's an exception.
Quick
Yes,
question from the audience. So Avery has a question about, so Bloom et al., if public firms are run as well as PE firms, then why would investors lock their money up for 10 years in a PE fund rather than, say, invest in liquid public companies?
Yeah, sure. That's a good point. So I think, Bloom's focus is on what the management practice is. And they find that at least using their scoring, their management practice is as maybe professionalized. So they have good HR, they have good professionalized management, but that's a different question from will the investors receive the benefit of that? And so the Jensen would say that, well, managed executives at PE, public corporations don't translate that into financial returns as well as the GPs of the private equity firms do, because there is this misalignment between the principals and the agent. Other questions?
That's all for now.
Okay, thank you. Okay. So I think this is the last source of value creation for GP. And then the idea here is that the GPs selectively buy undervalued assets and sell high. So this is, note that this is not really mutually exclusive from everything else that we said. Everything else we said is about what the PE GP does after they buy the companies. They can be doing both. And again, the theory in PE doesn't really emphasize this. And that's kind of interesting because selecting as a value channel is assumed in the VC literature, and it is found to be significant. But PE literature, at least in the theory side, doesn't really have paid that much attention to that. There isn't a lot of papers, but there are papers that suggest that this is part of the returns that the PE is providing to the investors. So, for example, Bergeron, Schlingerman, and Stoltz-Zutter find in a big study of acquisitions of public companies that PE pays lower takeover premiums systematically relative to other buyers of public companies. So they pay less. Go Hotchkiss, Song, and Acharya and Kehoe find that post 1980s public to private LBOs don't improve operating performance significantly, but they achieve high financial returns. That's not exclusively pointing to buying undervalued assets, but it's consistent with it. Stafford has an interesting paper that identifies certain characteristics of the firms for PE targets. So he finds that the GPs focus on value firms with strong earnings, and those firms would then perform well afterwards, and adding their leverage even boosts the returns even more. So he can replicate the overall returns of private equity by selecting public value firms with strong earnings and simulate levered investments in those portfolio of companies. Harford, and finally, Harford, Stanfield, and Zhang forthcoming paper documents evidence of timing and undervaluation in management buyouts. So to the extent that the management buyouts are using the PE sponsors, this points to undervaluation. So these collection of papers, the evidence is focused in, concentrated in public firm takeovers. So again, this is quite still suggestive, but there is potentially a transfer from public shareholders to private equity.
Ayako, can I interrupt with a question?
Of course, of course.
So I was very interested in this, the fourth channel on the financial constraint.
Mm-hmm.
So the question is, I feel like, yes, PEs can resolve them, but it's kind of an expensive type of capital to introduce in order to address financial constraint. Like, are there specific type of firms that will use PE rather than, let's say, banks or public equity or other source of financing sources to address their financial constraint? Is there, like, are they particularly risky or distressed or things like that that make PE a value source to resolve their financial constraint rather than, let's say, banks and so on?
Right. Yeah. So yeah, that's a very good point. And I think we can point to a couple of papers that look at the credit access that the PE brings in. So Demiroglu and James and Ivashina and Kovner, they're two contemporaneous papers from the 2000s. They find that more prominent PE funds get cheaper loans and even loans with looser covenants. So that suggests that same assets, but once you're under PE ownership, you enjoy this access to cheaper cost of capital using the reputation and the repeated transactions of the PE funds. So I think this financing constraint channel is really pointing to more of a private to private deals of firms that have growth potential, not really distressed firms, but growth potential. And yet firm itself perhaps doesn't have the reputation with the bondholders or the banks to really expand as much, to invest in that positive NPV growth potential they have. And PE then unlocks that. Does that answer your question?
Yeah. This wonderfully. Thank you so much.
So now I move on to value impact on stakeholders, and I'll start with workers, then consumers, and time permitting others, but I know time is going very fast. So definitely get to workers and consumers. So I really recommend this pair of papers by Davis et al. And I put all the authors' names there. It's really wonderful. What we learn is so rich here because they have the access to the census, firm and establishment level data. And in the 2019 version, they merged with other sources. So this is really a universe of both public to private and private to private targets. And then we really learned the difference between the two in the 2019 paper. Here, everything they measure is measured against matched control firms. So in case of public to private targets, they are being matched to public companies that are similar ex ante and remain public. They find that the jobs levels at the plants, the change is correlated with the productivity of the plants. So at the low productivity plants, the jobs go down, jobs are cut. High productivity plants, the jobs actually increase. So there's reshuffling of jobs across different units. And this leads to overall productivity increase at PE-owned firms. Now, a public to private targets job decline by 13%. And in contrast, at private to private targets, jobs just happen to be the same number, increase by 13%. Again, pointing to this easing of financing constraints for private targets, but very different outcome for public to private. And that makes sense because presumably public companies before the LBO were not financing constrained. And so there are very different types of targets that then meet different outcomes. Overall, the net job loss is about 4% after you exclude the divestitures or add-on acquisitions that they do after the deal. So the organic net job loss is it's a modest level, but that minus 4% really hides this huge heterogeneity across the deals. The wage goes down modestly, 1 to 2%, and that pretty much erases the initial higher wage level relative to the control firms. And so post-deal, the wage is converting to the level of the control firms. Overall, there's a big productivity gain, and that's done through this job reallocation. The productivity gains is, however, small for deals that are done during easy credit conditions. So suggesting that when the credit is cheap, financing engineering dominates for rationale for doing deal making, and those deals tend to result in smaller factor TFB gain. And importantly, the paper documents also that public to private deals, job and productivity outcomes are sensitive to credit spreads and GDP growth after the deal. So if the deal is done and then the spreads widen or the economy goes into recession, that's when the job outcomes, the job losses are big and the productivity doesn't increase. And so I just want to summarize that really important point here by just quoting from Davis et al. It says that the public to private deals proliferate in advance of credit market tightening, and their targets exhibit large post-buyout employment losses and poor productivity performance during downturns. Now, the question that they raised but can't really answer, but I think it's a really good question that they're asking is, do public to private buyouts cause avoidable employment losses, or were target firms in dire need of restructuring? Given the productivity gains at target firms, were the match control firms also in need of major restructuring? And I think that's a very fair point to make. Another thing that really this paper illuminates this bifurcation of private equity outcomes and the type of deals they do between public to private versus private to private. We find consistently across many papers that public to private targets were inefficiently run ex ante. So when the plan is implemented, the productivity gain is correlated with job cuts, because that was the rational thing to do. They're dependent more on financing engineering as opposed to operational engineering. And when the spreads goes up after the deal, the outcome is really negative. And yet these are 10% of deals, 30% of the jobs overall in the universe of PE deals. These are, however, the most visible ones, whether it's Toys R Us, all the usually brand companies that get highlighted a lot. So these are the PE deals. And I think they drive the hostile public sentiment towards PE. We have a very different picture emerging for private to private deals, where the targets are human resource or financing constraint. They can't hire talent and they're financing constraint. So after the deal, the productivity gain is associated with job gains. There are growth-driven companies, operational performance improves, and these are 90% of deal count and 70% of the jobs under PE employment. And yet these are largely invisible to public, invisible even to us, because we don't really recognize these private companies that the PE is doing every day. There's even richer evidence at the granular level for outcomes for workers that really point to that bifurcated outcomes on workers. Agarwal and Tambe studies this really interesting comparison of what happened to PE-owned and non-PE-owned firms and the workers who work there with respect to their IT investment. They first find that the PE-owned firms invest more in IT diffusion, especially after year 2000, compared to non-PE-owned control firms. And this has impact on the workers even after they go to other jobs. Their argument is that because of this higher IT diffusion investment, workers at PE-owned firms have increased IT skill requirement on the job. So they get these new skills that are required, and it has a spillover effect on the workers' human capital. So when they go to new jobs, they are more employable. Their unemployment spell is much shorter, and they get paid more compared to workers who worked at the non-PE-owned firms. So this, and then they show robustness of these results by showing that the results is focused on PE with IT focus, PE that invest more in IT, workers with more IT complementary tasks, like their job has more to do with problem solving or analytical tasks, and workers with college degree. In sharp contrast, Olson and Tag finds that PE takeover triggers, and again, this is thought of as a rational implementation of value creation for shareholders. They trigger automation and offshoring. So unemployment incidence is twice as high for workers in offshoreable or routine types of jobs at low productivity firms that the PE takes over. I can't list all the other wonderful studies on jobs, but just one other very interesting unique paper to highlight is Faccio and Su. They study political connections and job creation. So they code PE firms as politically connected if an officer or important employee has been a high-level political officer. So for example, Kenneth Millman at KKR is a former chair of Republican National Committee. Colin Powell at Fortsman Little is a former Secretary of State, so things like that. And they find that jobs increase faster at connected PE's portfolio companies. This increase is stronger during election years and in more corrupt US states. And they show evidence that this seems to happen through government contracts and procurements. So I think this type of political economy aspect of PE is really fascinating, and there more papers should be written on this. Moving on to consumers, this is actually pretty interesting. There's quite different outcome depending on the competitive environment of the industry that the portfolio companies are in. So when the companies are in competitive industry, outcome for consumers tend to be beneficial. So Bernstein and Sheen finds that the restaurants are cleaner, better run, menu prices go down. Fracassi, Privitero, Sheen finds that prices are kept flat, but there are more variety of products, so consumer wins. Chevalier's really early supermarket studies, this is more nuanced, and whether the supermarket raises or drops prices really depends on the very local competitive environment and whether the competitors is dominant and the competitors is leveraged or not. In a more opaque industry, Spurgeons and Steiner study hotels and find that actually PE on hotels is operationally not very distinguishable from others. So their financial returns comes from something other than the actual operations of the hotel. And they posit that it's about selling at high price. Very different outcomes for subsidized or regulated industries. Eaton Howell Yanelis studies for-profit college and find that after PE takeover, graduation rates and earnings of graduates drop. And in another study, Gupta, Howell, Yanelis, and Gupta find that for skilled nursing homes after takeover by PE, compliance rate and patients' health measures also decline. There are a couple of papers that are very new that looking at the COVID impact or the PE impact during COVID. And here the results seem quite mixed at so far. So these are still early days. So one paper finds that PE-owned nursing homes have less PPE. Another paper finds more PPE and lower case. So I think the jury is still out on this. Regulated industry also find that the PE is quite sensitive to the regulation and sort of push the envelope. So Kilty and Sarin, again, the insurance studies find that insurers owned by PE immediately engage in credit rating arbitrage using asset-backed securities because of the regulation, the way it's set up, buy more ABS at a higher yield don't result in higher capital costs, and they do this by swapping high-rated corporate bonds with ABS to boost the yield while keeping the capital cost low. And Bellon, in studying fracking firms, find that they generally choose low pollution choice, but once the regulation is rolled back, they immediately increase the pollution choice of their technology. In the interest of time, I won't go into competitors and suppliers. For governments and taxpayers, there is a sort of a interesting mix. So Johnston, Ross, Puri, and Ma look at the PE's participation in the failed bank resolutions after the financial crisis. And here they find a positive role played, stabilizing role played by PE. They fill the capital gap and acquire more riskier underperforming banks and turn it around well. These are the banks that other banks wouldn't be interested in buying. Whereas the studies that we mentioned in the regulated and subsidized industry paints a more negative view, because that means the government's tax revenues are reduced and expenditures on things like student grants and medical reimbursements are increased. Okay, so now it's so I'm moving on to society and environment, but before I do that, are there any questions on stakeholders, value creation, consumers and workers.
I don't see any new questions on that topic. So
Okay.
If you don't mind, actually, I have a
Oh,
follow-up
there you go.
question.
Yeah.
So I think the two first sections about the creation for the shareholders and for the stakeholders, I think an immediate question that come to mind is there a real like zero-sum game of those two? Basically, like we separately studied, okay, how that on average happened to shareholders and how that on average happened to stakeholders. Do we know, for example, the deals that perhaps do better for the shareholders are those who are actually doing worse for the stakeholders? Like, is there a competing kind of elements? Because I think the narrative from the policyholders perspective is like there is a narrative of their
it's a zero sum.
I'm benefiting the shareholders and so on. We seem to find evidence of the positive too, but do you think there's a zero sum game of some kind in this aspect?
Well, I think reviewing these different papers and sifting through, what really emerges that's so interesting to me is that there are these two types of targets that are very, very different in nature. One is bigger, more mature, and perhaps inefficiently run. They tend to be public to private deals. And when those deals, the value creation for shareholders tend to be negatively correlated for stakeholders like workers. And that's not necessarily because PE is evil, but because perhaps the publicly run firms should have been implementing those strategies, but they weren't because of the misalignment of agency principle relationship between shareholders and management. On the other hand, we also, I think this is the part where probably for public relations, PE should emphasize a lot more, is the type of deals that tend to happen in private to private deals, where the type of companies that they take over is financing constrained. So when that financing constraint is removed by PE, there is the value creation that's correlated with job creation or even spillover in terms of skill. And so this is where the rent is shared more with the stakeholders. And similarly for competitive industry targets, the value created is shared with consumers, whereas in the more subsidized and regulated industries, the rent and the value created on behalf of the shareholders seem to be negatively correlated with the consumer outcomes, where the consumers here are students or the patients. So I think you really have this heterogeneity of the outcome, and documenting that and communicating that clearly to paint a more comprehensive picture. I think that's what these more recent studies are doing a really great job. And but there's more that we need to dig into. So generally, I think this agency public company theory of PE then go to these public company outcomes that are some are grim. But I think there are other types of PE that maybe the original theory didn't even emphasize, but yet seems to have a more positive correlation in terms of economic outcomes for other stakeholders. And we need to explore that more.
Thank you.
Thanks, Son. And that's a perfect segue for thinking about the next topic, which is the more broader impact channels for society. So I'll pick three topics: just innovation, environmental damage, and impact investing. So the question on innovation is an important one. Turns out it's also a kind of hard one to answer. So the question is, do LBOs lead to reduced innovation that's harmful? Or again, this is sort of what the Davis et al. Paper was saying about the jobs. Or does PE tend to acquire firms that were sitting on intellectual property that was inefficiently run and managed, so it's optimal for them to scale back? It's hard to say. And also all these studies use patents, and they do what they can to qualify it, but the patents are imperfect metrics of innovation. And again, the paying attention to public to private versus private to private deals, they again find bifurcated outcome. So for example, Ames, Stiebel, and Wright, I think this is a UK sample, finds that the private equity relax financing constraints and increase quality adjusted patenting by 6% in private to private deals, but not for public to private deals. So that again echoes this gross LBOs that that's associated with more innovation and a growth, but only for private to private deals. Lerner, Sorensen, Stromberg study post-buyout firms' patent programs become more focused and they become better cited. So they might not necessarily increase in quantity, but there is evidence that it is a more productive innovation that they are focused on. Ayas and Egan finds that for public to private deals, the quantity of measured by patents, both new patent grants and purchases go down and the sale of existing patents go up. So portfolio of patents in public to private deals shrink significantly. Again, I find the interpretation of these results are a bit ambiguous because this is relative to public control firms. Are these control firms that hold onto the patents that they have? Maybe are they inefficient, or is private equity killing innovation? Public to private deals, there is reduction. For private to private deals, there's increase. So, I mean, maybe one way to speculate about this is that for private to private deals, the investment level before PE tends to be below the optimal net investment level, and for public to private deals tend to be here, although we don't know for sure. And when the cost of capital goes down for private to private deals, there is an increase in the net investment in innovation. I think that one for private to private deals, the interpretation seems less difficult. For public to private, it is harder to say definitively. The paper by Shivet and Foster is motivated by a recent paper by Hart and Zingales that say that the public companies underweigh negative externalities, for example, for environmental harm, than privately held companies. So that suggests privately owned firms do less environmental harm. An interesting question is there a difference between PE-owned and non-PE private companies' behavior? So Shivet and Foster does that and find that the private and independently owned firms, so like individual owned firms, greenhouse gas emission is less than public firms, as Hart and Zingales suggest. But for PE-owned firms, the emission is not distinguishable from the public firms' emission. Bellon, again, this is a study of fracking firms, very good paper. The PE-owned firms choose less pollution technology in general than non-PE-owned firms. But as I said already, and this is a good identification in the paper, that there is this nice exogenous variation when the regulatory risk goes down for federal land fracking in the recent years during Trump administration. And they find that the PE's polluting choice goes up immediately, but only on this federal land fracking. So that's, and they also find that choosing low pollution technology is inconsistent with the long run profit maximization. So both of these studies suggests that the PE choices here are motivated by materiality rather than pro-ESG preferences. But what if the investor preferences change? Would PE behave differently? And that's something that, having been done, because investor preferences in the past was at best materiality oriented. But that's, I think, is a very important question to think about and study going forward. So I know I'm getting close to the end, but I really want to talk about pro-ESG investors and PE here. And So pro-ESG investors are investors that not only think about ESG as a materiality issue, but to actually have ESG in a utility function. Is private equity compatible with pro-ESG investors? I think I have to skip this mostly, but these are both really great papers to motivate this issue, so highly recommended. Only thing I say here is that these are both theory papers, and find that for pro-ESG investors, willingness to give up return in exchange for investing in green company and green tilted portfolio implies lower cost of capital for green firms, and pro-ESG investors enjoy investor surplus despite earning negative alpha because of their preferences. So, so impact funds are funds that intentionally aim for both financial returns and this non-financial impact, mostly happening in VC space, but recently buyout funds started to raise impact funds. So there is a significant ramp up in the amount of AUM of dedicated impact funds in the last couple of years. So with that as the backdrop, I studied impact investing, and in our paper, the sample is of VC funds. And it's motivated by this sort of frustration that we had with the discussions among the practitioners who say that you should do ESG because doing well leads to doing well by doing good. But doing well by doing good assumes that the investors are not willing to sacrifice financial returns. Also, US pensions have this fiduciary duty definition that prohibits them from considering ESG factors if the financial returns are sacrificed. So that suggests there is this constraint that the investors are bound by. But this claim that you can get higher financial returns by doing ESG, or at least as good returns, also leads critics to dismiss impact investing as greenwashing, just some marketing without any actual impact. But what if some investors can and are willing to sacrifice financial returns? So that's what we aim to study here in VC space. So we, using random utility willing to pay type of models, discrete choice model, and using the investors' observed choice of investments in either traditional VC funds or impact funds, we measure this willingness to pay. And we find that the LPs accept on average 2 to 3% lower expected IRR. So that's the willingness to pay for impact funds compared to traditional VC funds. So that's in line with the Pastor, Stambau, Taylor papers results. And certain types of LPs have this willingness to pay that's higher: development organizations, foundations, public pensions, European investors, and UNPRI signatories. In contrast, investors that are bound by the US-style fiduciary have low willingness to pay. So two implications here are that impact investors value ESG outcomes and are willing to trade off financial returns. And US-style fiduciary duty might constrain some pro-ESG investors' welfare maximization. And when you break down the willingness to pay by the category of the impact that the funds focus on, we also find that investors are willing to forego more returns when the category is associated with high public good or externality. So while preparing for this talk, I read this. It's a short kind of a note by Fama called "Contract Costs, Stakeholder Capitalism, and ESG," and it's a short reading, but it's very, very illuminating. So I again recommend that. And he talks about contract costs of actually implementing ESG, and it's a very fair critique because he of course, thinks that the wealth maximization is still the better way to go. The reason is the welfare has multiple dimensions, and tastes for different dimensions vary across shareholders. So how do we write and enforce a payoff function where the managers are evaluated on these multiple dimensions when we have this randomness in outcomes? That's a very difficult problem, and this puts us in a quagmire of satisfying the divergent tastes of shareholders, implying high contract costs. So this problem is definitely real, but it seems that it's more solvable for private equity than for public firms. Limited partnership agreement is a take it or leave it contract. It's a finite time, and GP can run different funds that have a different menu of contracts to meet the divergent preferences of LPs. LPs can opt in or out. Number of LPs finite, so it's more manageable. Once committed, LPs are locked in, and we can restrict secondary sales of fund interests. So all these problems we have with the public corporations and public shareholders, it seems more solvable with the PE format. So it's plausible that PE is more compatible with this ESG, pro-ESG investments than public corporations might be. So I'm almost done with my slides, and here is just a summary, one-page summary of what the literature has shown so far. And then I have some suggestions for research coming up. So the literature identify 5 value creation for GPs. Those are governance, financing, engineering, operational skill, financing constraints, and selection. And all create value, in some case transferring from others, but accruing to GPs. For stakeholders, we find that high-skilled workers tend to benefit, whereas low-skilled workers are less likely to benefit. Consumers in competitive industries tend to benefit, whereas consumers in subsidized or regulated industries are less likely to benefit. We find that the private-to-private deals are positively correlated with growth, innovation, and value creation, whereas public-to-private deals are more positively correlated with job loss, poor outcomes during economic downturns due to perhaps financial engineering dominating the rationale in under easy credit conditions. There's some suggestive evidence that the politicians and PE might mutually benefit. Environmental impact depends highly on the regulatory risk that the companies face and the materiality of that risk. And finally, impact investors are willing to accept lower expected returns. So I have some suggestions for research. I think it would be fantastic to see more papers on these areas. One is political economy. We have some very interesting suggestive evidence so far that the PE is very savvy when it comes to regulatory arbitrage, but they have better compliance when the reputation matters, may win government contracts in exchange for jobs, some evidence of value extraction in regulated and subsidized industries. So there are lots of questions that I think pertain to political economy of PE, such as these that the researchers can look into. The second area in particular, the regulation seems to be a really important source of the value creation for PE. They are very, and in some cases, they might even influence regulation, but regulation also influences their actions. So that dynamics seems very ripe for more research. Also, do they interact differently with different political regimes? We have just more studies coming out of US, but what about EU, China, emerging markets? I think those are really great questions. Another thing that is very recently happening is more tech in private equity. About 20% of PE investments are now in tech. This happening because tech is also a bigger portion of the overall markets. So do PE-owned tech firms innovate differently? Do they behave differently from public tech firms or VC-backed tech firms? And what is the value add for PE specifically in tech industry? The Vista is a company that specializes on software company, LBO, and they supposedly have 110 instructions on how to run software companies. So that's just some operating skill there, but we don't have much systematic studies on this. And finally, I'm obviously interested in the ESG and impact and PE. So, following Fama's challenge, does PE solve this divergent taste problem of responsible investments better than public corporations? Can we do ESG scoring for PE-owned firms in the way that the public companies are ESG scored? What's the role of green banks in impact buyouts? And can GPs be contracted to be evaluated and even compensated on some predefined ESG outcomes as well as financial returns? I think these are all great areas for future studies. So that's all I have. Sorry, I perhaps rushed a bit, but there was a lot to go over, and I'm happy to stay and get as many questions as we can.
Wonderful. That was great. Thank you. I certainly learned a lot, and I think the audience did as well. We had a pretty high stay rate. Normally we lose people early, so you clearly kept people engaged most of the time. So if anyone has questions, feel free to use the chat, unmute yourself. Ayako's been generous with her time, so feel free to ask something.